For tonight's interview, we talked to President of the Federal Reserve Bank of Chicago, Austan Goolsbee. He also served as President Obama's senior economic advisor. As the Fed tries to manage the cool down of inflation, President Trump's tariff policy has injected a high level of uncertainty into the economy. And that presents a challenge for the Federal Reserve Bank presidents like Goolsbee. Let me see if I can frame what it sounds like the Fed's puzzle is. One puzzle is prices might go up as a result of tariffs. The other thing is, do you see any data that suggests growth might be going down? And does that make the job harder?
That makes the job of the Fed harder if you get what is clearly a stagflationary shock, which is to say both of the Fed's jobs, maximize employment, stabilize prices, both of them start getting worse at the same time. That's not usual, but it does happen. And when it happens, there's not a generic playbook that you turn to. How the central bank responds to a negative supply shock, that's what we call it, a stagflationary thing, depends on, well, which one's worse and how long are they going to last? And are the prices going up transitorily, or is that a permanent? Or on the growth slowdown side, is this just a matter of resolving uncertainty, or is it spiraling more into recession? It's a little bit of a sunburn. You know, should we put on sunscreen today? I don't know. If you look down and you have the sunburn, yep, you should have put on sunscreen. You know, and it's got a little component of that.
What is the most interesting part of the economy that we're not talking about that you're interested in?
90+% of what happens with economic growth has nothing to do with Washington. It's just the private sector doing its thing. We're innovating, we're coming up with new technologies, and that influences what the economists look at the most, which is the growth rate of productivity in the economy. It's the single most important number that you've never heard of and you're not talking about, but we should be, because it is the thing that determines how fast can our wages grow without inflation. It determines what is our standard of living over the long run. And oh, by the way, in the last 2 years, there's been a dramatic and rapid increase in the productivity growth rate. Maybe from flexibility in the workforce, maybe from the fact that we've had a big increase in business dynamism and just starting new firms, maybe because of AI and technological improvements, but it's absolutely worth keeping our eye on this thing over the long and even the medium run, because its importance for the economy ultimately dwarfs by far anything that we're talking about this week.
And tell me if my history is wrong here, but the 1960 to 1970 period that people associate with good economic conditions before the early 70s, where the productivity growth is associated with some of the best times in American economic activity.
Of course, productivity is just output per person, output per hour of work. And if that goes up because we have better technology and we have these innovations, people can be paid more. So if you look in the 50s and 60s in the United States, boom times for productivity and for the standard of living. And then as you go into the 70s and things turn sour, productivity slows way down. Coming out of COVID, we've had a tantalizing increase in productivity. It does make you a little nervous when businesses, when they're looking at tariffs, start saying, wait a minute, if you start raising the cost of our components and supplies, it may slow our productivity, but this thing over the long run is by far the most important thing to watch.
So the uncertainty could be strangling the golden goose of productivity.
Let's hope we don't strangle the golden goose of productivity, but there are threats.